Hey everyone, ready to dive in. We're going deep on the Forex market today, and gotta say, some of this research is dense.
Yeah, it's complex, but that's what makes it so fascinating. We're going to unpack how it's evolved, who the big players are, and even tackle how to measure something like liquidity.
Okay, so let's unpack this Forex thing first. Did you know it's the biggest financial market worldwide? We're talking trillions daily.
6.6 trillion to be exact. And what's interesting is it's not just for those big banks anymore. Anyone can jump in these days.
Wow, so for someone like me who's just starting out, what even IS Forex?
Think of it as a global marketplace, but instead of goods, you're trading currencies, buying one, selling another at the same time.
Like when I get euros before trip to Europe.
Exactly, but way bigger scale. We're talking banks, corporations, hedge funds, even individual traders like you.
So it's come a long way from those currency exchange booths at airports.
For sure. It's had a major makeover in the last few decades. One big change is from a two-tiered system to something much more fragmented and interconnected.
Break that down for me. What was this two-tiered system like?
It used to be dealer-driven. Big banks were the middlemen, setting rates, taking their cut with each transaction. But electronic trading platforms changed things.
So less reliance on the big banks?
Exactly. Prime brokerage opened the door for smaller players, like hedge funds or even individual traders. They could bypass the old dealer network.
I bet tech played a huge role in this too.
Huge. The early 2000s were a turning point. Electronic platforms exploded, made things faster, more efficient. And that led to algorithmic trading. Computers making trades based on preset instructions.
Algorithms make sense in a fast market like this. But with all these players and new tech, how does it all work now? Who are the key players to watch?
Dealers are still around, but their shares actually shrinking. One you mentioned are principal trading firms, or PTFs. They use serious algorithms and high-frequency trading to make millions of trades super fast.
It's like something out of a movie.
It's wild. Shows how much things have changed. It's not just PTFs, though. You've got hedge funds, corporations managing their international stuff, even central banks stabilizing their own currencies.
A real mix then. Within this whole ecosystem, can you explain some key parts? Like one source mentioned the spot market. What is that exactly?
The spot market is the most direct way to trade currencies. It's where they're exchanged for immediate delivery, meaning it happens right then and there.
So like me exchanging dollars for euros right now for my trip would be on the spot market.
Exactly. It's the most common way to trade and makes up about 30% of the total global turnover. So it's the second biggest submarket in Forex.
Okay, so immediate exchange.
Yeah.
But how do people actually make money in Forex?
It all comes down to profiting from those exchange rate changes. But it's not as simple as just buying and selling randomly.
Figure there was more to it. So what are some strategies traders use?
There are a bunch of different strategies, but understanding market dynamics is crucial. One common way is analyzing supply and demand zones on price charts. These zones are where the price moves sideways before a big move up or down.
So like finding potential turning points.
Precisely. Recognizing those zones helps traders see buying or selling opportunities.
And the source mentioned different types of trading, like scalping and swing trading. What are those?
It's like choosing your own adventure. Scalpers go for quick profits from small price changes, often holding trades for seconds. Day traders, as the name suggests, open and close within one trading day. Swing traders ride price swings holding for days or weeks.
And then you have the long-term folks, right?
You got it. Position traders can hold for months or years. The key is finding a style that matches your risk tolerance, your time, and your investment goals.
Sounds like there's a strategy for everyone in Forex.
That's the beauty of it. It appeals to such a wide range of traders.
But with trillions flowing around and all this activity, doesn't it get unpredictable? How do traders handle that?
Liquidity is key here. It's how easy you can buy or sell a currency without drastically changing its price.
So high liquidity makes it smoother for traders.
Exactly. Lots of buyers and sellers means trades happen fast with little price impact, but liquidity can change.
What causes those changes?
Lots of things can affect liquidity. Market volatility trading, volume, global events like economic news or geopolitical shifts. To measure this, the Riksbank in Sweden created the Krona Liquidity Index.
Interesting. So how does that index actually work?
They track things like bid-ask spreads, which is the difference between buy and sell prices, and trading volume to see how easily the krona can be traded.
Like a barometer for the krona's flow.
Precisely. And their research shows a link between krona liquidity and global risk aversion.
So when investors are nervous, the krona gets less liquid.
That's what they've seen. suggests that watching Forex liquidity could be an early warning for bigger economic downturns.
Pretty insightful. So we've got all these players, super fast trades, changing liquidity. How do traders keep up?
That's where the power of algorithmic trading comes in.
All right, we talked about that earlier. Sounds like they're getting more important in this market.
Very much so. Algorithms are great at navigating this fragmented market, automating execution, and even meeting those tougher reporting rules.
Speaking of rules, what about regulation? Is anyone making sure things are fair?
Great question. Regulation is key for fairness and transparency in Forex. We have groups like the Global Foreign Exchange Committee, or GFXC, promoting ethical conduct and best practices.
So it's not a complete free-for-all.
No rules are in place, and they're always evolving to match the market's growing complexity.
Good to know. All this talk about complexity and algorithms makes me wonder, is there even room for human intuition anymore? Or is it all about the fastest computers?
That's a great question. It gets to the heart of the debate about the efficiency of the Forex market. Older ideas said that order flow, meaning patterns of buy and sell orders, could reveal market sentiment.
So you could predict price moves by analyzing those patterns.
That was the thinking. But new research suggests something different. It might be the dealers, those big banks we talked about, who actually have the best info.
So even with all the algorithms, human intuition still matters.
It seems so. Dealers have tons of info and experience that even fancy algorithms can't quite match.
Interesting. Sounds like a constant battle between human intuition and technology.
Mm-hmm.
But no matter what, risk management is key.
Absolutely. You have to manage risk effectively in a market as volatile and dynamic as Forex.
What does good risk management look like?
One big one is the stop-loss order. It automatically closes your trade at a certain price to limit potential losses, like an emergency brake.
So it's not about avoiding risk, but managing it.
Exactly. You have to figure out how much of your account you're willing to risk on each trade, finding the balance between potential profit and acceptable risk.
This deep dive is already eye-opening. I'm seeing Forex in a whole new way.
We've just scratched the surface. There's so much more to discover.
Can't wait to keep going. But for now, let's give our listeners time to process all this. We'll be back with more insights into the world of Forex. Stay tuned.
Welcome back. Ready to keep exploring Forex?
Definitely. We've covered a lot, but I'm ready to go deeper. I'm especially curious about how traders make decisions in such a fast environment.
Great point. A lot of what we talked about is the market's mechanics, but the human side is huge too. Let's talk about a specific type of trading technical analysis.
Okay, I've heard of that. Is that where they use charts and patterns to try and predict price moves?
Exactly. It's all about finding trends and patterns in past price data to make smarter trade decisions.
We talked about supply and demand zones earlier. Do they play a role here too?
Absolutely. Those zones show where the price paused before a big move, right? Technical analysts use them to figure out potential support and resistance levels.
So it's like looking for clues on the chart to see where the price might turn around or keep going.
Exactly. They also look for other chart patterns, like triangles, flags, head and shoulders formations.
Those sound complicated. Do you have to memorize all those?
There are a lot, but you start recognizing the common ones with practice. And remember, technical analysis is about probabilities, not guarantees.
More of an art than a science then.
You could say that. It's about interpreting patterns, understanding the bigger market picture, and always managing your risk.
One source mentioned Fibonacci retracements. Sounds a bit intimidating.
It might sound complex, but it's actually pretty practical. It's based on a math sequence where each number is the sum of the two before it chains. Traders use these ratios like 38.2% or 61.8% to find potential support and resistance levels.
Still trying to wrap my head around that. Can you give an example?
Imagine a currency pair going up. If it starts to pull back, traders might look for support at Fibonacci levels, like 38.2% or 61.8% of that upward move.
So you use these ratios to guess how far a pullback might go before the trend continues?
Exactly. Fibonacci retracements help traders find entry points for their trades and also set stop-loss levels.
Okay, that makes more sense. So we have these charts patterns, Fibonacci levels. How do traders actually know when to buy or sell with all this info?
That's where signals come in. Think of them as alerts for potential opportunities.
Like a notification saying, hey, good time to buy.
Exactly. Signals can come from different indicators, moving averages, oscillators, even those chart patterns.
One source mentioned moving averages. How do those work?
A moving average is a line on the chart that smooths out the price changes over a certain time. Traders use multiple moving averages with different time frames, like short-term and long-term, to find trends and potential buy or sell signals.
So if a short-term moving average goes above a long-term one, that could be a buy signal, like the price is going up.
Right. It could mean the upward momentum is getting stronger.
Right.
But no signal is perfect. You have to look at the whole market and manage your risk.
It seems like technical analysis is a lot about recognizing patterns and understanding data.
It is, but with practice, it becomes second nature. And the more you learn about it, the better you'll be at navigating Forex.
Okay, for someone brand new, where's a good place to start?
First, you need a good charting platform. Lots of options out there, free and paid. Then it's about learning those chart patterns indicators and how to read them. There are tons of resources for that.
One source mentioned demo accounts. Are those good for beginners?
Absolutely. Demo accounts let you trade with fake money, so you can try strategies and get a feel for the market without risking real cash.
Sounds like a good way to build confidence before going live.
Exactly. You can experiment with different trading styles. Find what suits you. Practice those chart patterns indicators and see how you react to market moves, all without risk.
So we got technical analysis and demo accounts. What other advice would you give a Forex newbie?
Focus on learning first. The Forex market is complex, so you need a solid understanding of the basics before even thinking about trading.
Yeah.
Learn about order types, how leverage works, what affects currency prices.
Makes sense. What are some good resources for learning about Forex?
So much info out there. You can find books, articles, online courses, even stuff on broker websites. Just do your research and pick sources that are reliable and trustworthy.
One source mentioned carry trade. What's that about?
It's a strategy where you use the interest rate difference between two currencies. You buy one with a higher interest rate and sell one with a lower rate.
Okay, sounds a bit tricky. Can you give a simple example?
Say the Australian dollar has a higher interest rate than the Japanese yen. In a carry trade, you buy the Australian dollar and sell the Japanese yen at the same time. You'd earn interest on the Australian dollars you're holding and pay interest on the Japanese yen you sold.
So you profit from the difference in those interest rates.
Exactly. But there's always risk. Like if the Australian dollar drops against the Japanese yen, those losses could wipe out your interest gains.
Seems like Forex is always a balancing act between risk and reward.
That's the key. You have to know your risk tolerance, understand the downsides, and have a clear plan.
One source mentioned risk management again. What are your top tips for managing risk well in Forex?
We talked about stop-loss orders. Those are crucial for limiting losses on any trade. Diversifying your trades is important too. Don't put all your eggs in one basket. Spread your risk across different pairs or strategies. And maybe the most important, never risk more than you can afford to lose.
Solid advice. Sounds like there's a lot to learn about Forex.
There is, but don't be overwhelmed. Start small, focus on learning. Don't buy into the get-rich-quick hype. Take your time, build knowledge, and gradually increase your trading size as you get better and more confident.
Great advice. This has been super insightful. So far, we've focused on the technical side, what other factors can influence success in Forex trading. It's amazing how deep this Forex market goes. We've covered charts, strategies, algorithms, even risk management.
It's a whole world, and we can't forget the most important part, the psychology of trading.
Right. Even with the best analysis and risk strategies, our minds can mess things up.
Totally. We're always fighting our emotions, and they can really affect our choices.
Fear and greed are the big ones, right?
For sure, fear can make us freeze, hesitate to trade or bail out too soon. And greed pushes us to chase profits, taking on too much risk. One source said it's straight up, normal doesn't make money here.
Wow, that's harsh. But I get it. Our everyday thinking doesn't always work in the Forex market.
True. Our brains aren't built for trading. We're prone to biases, emotional reactions, habits that can hurt us in such a fast, unpredictable environment.
One source mentioned monetary attachment. What is that?
It's that feeling of being too invested in a trade, not just financially, but emotionally. When you're too attached to the outcome, you can't think straight.
Like betting your rent on a single trade and stressing over every little change.
Exactly. With that much emotional baggage, it's hard to stay objective. You might hold on to losing trades too long, hoping they'll turn around. Or exit winners too early, scared of losing your gains.
So managing emotions is just as important as managing money in Forex. How do we overcome these mental challenges?
First, realize emotions are part of it. Don't try to ignore them, that usually backfires. Learn to recognize them and control how they affect your trading.
Makes sense. One source said to think of losing trades as the cost of doing business. Interesting analogy.
It's a good way to think about it. Every business has expenses. Losing trades are just part of the game. The key is to have a system that makes more profits than losses over time.
So focus on the long game. Don't dwell on individual wins or losses, but look at how your system performs overall.
Exactly. Have a plan. Stick to it. Don't let feelings throw you off.
The source also talked about routines. Why are they important for Forex?
Routines bring structure and discipline, crucial for anything, really, especially trading. Have specific times for market analysis, planning, executing trades. This helps you avoid impulsive moves and stay focused on your strategy.
So treat it like a job, not just a hobby you do on a whim.
Exactly. If you want consistent results, you need a consistent approach.
All this psychology stuff makes me wonder, are there any personality traits that make someone better suited for trading?
Good question. Anyone can learn to trade with the right knowledge and mindset, but certain traits can help.
Like what?
Discipline, patience, resilience are huge. Successful traders are usually analytical good with numbers and data. They can control their impulses and stick to the plan even when things are tough.
So it's not just about taking risks, like some people think.
Not at all. Actually, the best traders are often the most cautious about risk. They know managing risk is essential for long-term success.
So it's about calculated risks, not just gambling.
Right. You need to know how much risk you're comfortable with and have a plan that matches that.
One source said, the secret is having realistic, balanced, and empowering expectations. Love that.
So true. Too many people come in hoping to get rich quick. That's a recipe for disaster. Set realistic goals, celebrate the small wins, understand that trading takes time and effort.
So enjoy the learning process, not just obsess over the end goal.
Exactly. Trading is a marathon, not a sprint. Focus on the journey, not just the finish line. And remember, even pros lose sometimes. It's how you learn. The key is to learn from those losses and keep getting better.
This deep dive has been incredible. We've gone from how the Forex market works to technical analysis and the psychology of it all. To wrap up, let's give our listener one last piece of advice. What's the most important thing for someone starting their Forex journey?
I'd say start with a solid base of knowledge. Understand the risks, create a strong trading plan, and practice with a demo account until you're making consistent profits. Most importantly, be disciplined and never stop learning. The Forex market never stands still, so embrace the challenge and keep growing your knowledge and skills. And remember, the journey can be just as rewarding as reaching your goal.
Fantastic advice. And with that, we'll wrap up our deep dive into Forex. Hope you enjoyed exploring this world with us. Until next time.